Hey everyone, Anthony here with InTouch Mortgage Solutions. It's Friday, Finance Fridays, and thanks again for clicking on this week's episode. Want to take an opportunity and unpack some of the bumpy roads that we see ahead for a lot of Canadians who have mortgages that are going to be renewing into higher rates. Just this week alone, bond yields have surged in the US and globally, impacting Canadian fixed rate mortgages as bonds in Canada obviously went onwards and upwards. And as we start to see these financial pressures unfold not only in the US, but globally, it's going to impact Canadians and their mortgages and their discretionary spending. It is the tale of two different economies. When we look at the US and the Canadian economy, many believe there could be a divergence about to take place when we think about where the US could be going with policy rate versus where Canada is and maybe has to remain. And obviously this is up for debate amongst economists as the jury is out. There's many that are on either side of the equation. When we look at the US, what happened this week and the previous week was that the US Federal Reserve decided to hit the pause button and hold policy rates steady while it takes an opportunity to digest its current economic situation. Not much different than what happened in Canada in early September when we heard the Bank of Canada hit that pause button to basically sit back and assess the current situation right here at home. Now, as these two different central banks assess the situations, I think there's a lot of data that's emerging that could be pushing them into either direction. If we look at the US, obviously it's facing an election in 2024. It has auto labor strikes in those car manufacturers, huge segment in the US. Obviously, we have other potential problems like higher oil prices that are not only impacting the US, but also Canada and the globe. And you have to take a look at the potential for a shutdown of the government in the US. And obviously, all these things are being digested. As a result of the pause, many economists are also looking at the situations in the US economy. What's coming out now is obviously that the US had decided to increase policy rate to tackle inflation and consumer spending, no different than here in Canada. While both central banks want to see inflation come back down to a relatively normal target range of 2%, they have a bandwidth between 1 to 3, but they're aiming for 2. Now, obviously, as inflation ticks up, there's a lot of things that both central banks do not have control over. They don't have control over necessarily food prices as well as fuel and energy. And obviously, these are things that are very volatile. And that's why they're stripped out of things like core inflation. Now, looking at those two things, we have to look at their economies. While the US economy seems to be very resilient and able to tolerate a higher policy rate, because consumer spending is still up and elevated, which is not really good news for the Fed as they look to tackle inflation, but it does give us an indication or an insight into what is happening. So why is consumer spending still resilient in the US? Why is retail spending still up? Well, obviously for some economists, they believe a few things. The Americans earn more than Canadians, but I think many economists are pointing to the deleveraging that occurred back in 07 and 08 when the US had undergone a major deleveraging in households with foreclosures and bankruptcies. We've all seen The Big Short. Obviously, this has taken a lot of debt out of the system. And with that occurring at that particular time, and obviously still remnants of what happened at that particular period in time, playing out in American sentiment. So there is a distinction here because in Canada, we are seeing consumer spending pull back. Finally, this is exactly what the Central Bank of Canada wanted to see. While the US seems to be accelerating, Canada seems to be decelerating. Now, that's not the only indication that will guide the Bank of Canada on whether or not to make a decision to hike policy rate or not. But it is important when you look at the economy, the GDP of Canada. When we start to see things like business sentiment pull back, we start to see unemployment tick up here in Canada where it might not be the case in the US. We see more immigration coming into the country, how that's playing into Canada as opposed to the US. We have a highly levered Canadian economy when it comes to debt and household debt. That is another major factor. Not only government debt, but consumer debt here in this country is a lot higher. Now, obviously the US has a lot of debt as well, but per person, there is a major difference. Canadians are amongst the most indebted in the G7. And obviously both economists, both central banks are very aware of those situations. Now, what's making these bond prices much more complicated for both economies, right? When we look at the US and Canada, is that the US has a 30-year mortgage. right? So 15 or 30-year mortgage means that Americans are locked in for 15 or 30 years, as opposed to here in Canada, where most Canadians are about a 5-year term, being the most common. Over the last little while, 3 years have been very popular, but mortgages are resetting much faster in Canada than they are in the US. And if you think about what happened over the last little while when interest rates went to pretty much near zero, many Americans may have locked into those lower interest rates for 30 years. Whereas in Canada, maybe you got into a rate in 2020, 2021, well, you're going to be approaching renewal in 2024, 2025, or even 2026, depending on what type of product you selected. So because of those resets happening more frequently, Canadian consumers are more impacted by these higher rates as these mortgages reset into higher rates. Now, obviously, if you have a variable rate mortgage, whether it be adjustable or a static payment or one of those variables with a fixed payment, and you look at those particular products, well, if you're an adjustable, you would have felt those increases instantaneously effective last March of 2022. If you had a trigger rate mortgage with a static payment, you might have now breached your trigger rate. You need to either increase your payments, fix the mortgage, put a lump sum in, or bring that payment up to date with where it should be according to today's rates. And obviously this is impacting negative amortizations, a whole separate conversation, very important to the banks as they see this as a major problem. As these mortgages begin to renew and reset, these clients that may have 90-year amortizations will have to snap back to potentially a 25 or 30-year amortization. And what is that going to do to the Canadian economy? Remember, the Bank of Canada wants these higher rates to play out, and we're starting to see that. It's actually biting really, really hard. And I think that bite hasn't even really taken a firm grip yet, because we had increases that happened just in June and July, let alone in later part of 2022. So you have to take into consideration that there's this lagging indicator when it comes to how monetary policy works. And the Bank of Canada is starting to really see all these contractions, all these numbers start to look worse and worse, which is better and better for the Bank of Canada if you think about it, right? They want to see people go through misery and pain in order for them to feel that they've done enough. Remember, the conversation is whether or not the Bank of Canada has done enough to impact inflation. And for those of you that may be aware, obviously we've talked about this on the channel, the Bank of Canada will choose a recession. They will increase policy rate to get that inflation back down to 2% or the band of 1 to 3, but ideally they want 2% at all costs. They will rather see inflation come down and induce a recession than to basically let inflation run hot. And the major reason behind that, at least in my opinion, is because we still feel those pressures from the 1970s and early 80s, late 70s with those Volcker era style inflation data, right? Where inflation picked up so high, then it dropped because the bank and central banks had pulled back, and then inflation ticked back up again. They had to smash it down with even higher rates. And I think the central banks are fully aware that that is not possible in Canada. We cannot let that happen. Our Canadian economy could not withstand those type of elevated rates. And obviously the conversation is when you look at the amount of debt in the system back in the late 70s and early 80s, as opposed to now, the increases that we've seen to the policy rate to get it to 5% is almost equivalent to what we saw when interest rates were at 19 and 20% and 21% back at that time, right? Because the indebted household. If you think about it, the amount of debt now to the amount of debt then, these increases, each 0.25% is going to have a monumental impact on highly levered households. And this is the conversation some economists are saying, that if the Bank of Canada and the fixed rate mortgages do not come down, there's going to be some serious pain in the markets ahead. We're already seeing a major slowdown with new credit creation, new mortgages. We're seeing a slowdown in housing sales and inventories are picking up. We're seeing builders pull back as the cost to build is way too expensive. And obviously with interest rates being where they are right now, is it going to work? Are we going to be talking about this for the next few years? As whatever inventory is not brought to market today, well, that's just kicking the can down the road for tomorrow. So obviously this is a huge conversation, and we definitely need some leveling off of these interest rates. We need something to happen in order to basically get back to some type of normalcy. And obviously, yes, there's millions of Canadians who want to purchase a home and they're waiting for these markets to just tank. But you have to understand, if the market tanks, What is going to be the reason behind that? And if the market tanks, well, are you going to be able to purchase a home? Is that going to be interest rates that are going to be way too high and you don't even qualify? And what's going to be the reason behind it? Is it going to be a recession? Are you going to lose your job? So even if home prices come down, but you're not working, well, guess what? Can you buy a house? Can you qualify? Is mortgage regulations going to change in order to make it even more difficult to buy a house in the future, especially if we start to see some internal collapses in the housing economy right here at home? Let us know in the comment sections below what you think. Are economists right? We think we'll see a cut in 2024 or 2025. And obviously, what will that do to the Canadian housing market? Do you think there'll be a resurgence if interest rates drop? Or are homes still too expensive? Are interest rates too expensive? Let us know in the comment section below your thoughts, but we'll leave the video here. Wishing everyone a wonderful Friday and an even better weekend ahead. Until next week, thanks for watching. Stay tuned.